you've always heard the expression cash is king. I really think liquidity is king. Whether it was COVID, like we had this very sharp temporary pullback in the stock market, real estate market, and then an explosion upwards, and 200% rally since then in the U.S. stock exchange. Mm-hmm. And the reality is, we don't know when the next recession will hit, but the economy works in cycles. There will be recessions, and having liquidity allows you to take advantage of opportunities when they come your way.
Hey, everybody. All right. First things first, apologize for kind of starting here late. I know we're about 12 minutes late. Brian and I have actually been having a nice discussion with you guys, thinking that we were live. The software said that we were live, and then all of a sudden we noticed after about 10 minutes, it actually turned itself off. So apologize for getting started here kind of late, but we will make up for it, I promise, with the content. For those of you that don't know, my name is Jamin Garabedian. I'm the founder of Assurance Wealth Management, and I'm a financial advisor. And today we're going to be talking a lot about life insurance and the benefits that you can get of life insurance beyond just the death benefit. And while I am a financial advisor, I do need to let everybody know that I'm not everybody on this call. I'm not your financial advisor necessarily. So please understand that everything that we're going to be talking about today is purely educational. It's informative. It's here for you to learn some things today about life insurance. Do not take this and go and run with it. Okay. Do not go and implement anything that we're talking about today. Talk to a professional and make sure that make sure everything fits your plan before you implement anything. Doing a little housekeeping here, but I do want to introduce you guys to the man when it comes to life insurance. Brian is going to talk to us a little bit about some strategies today. We're going to go everywhere from basic strategies to more advanced strategies. We're going to talk about different ways of using life insurance for different types of people. And pretty sure that throughout this presentation, you'll find out that something in here fits you. I mean, there's a good chance that something's going to fit you in your situation. And if that's the case, talk to a professional about it, see if it does fit your financial plan, and then maybe you can get some of these implemented on your behalf. But Brian, if you would, just tell everybody a little bit about who you are, kind of what got you into the industry, why you chose life insurance as a career path,
Totally. Yeah. So I guess to start off, I don't think many kids grow up thinking, I want to be in the life insurance industry. It's usually astronauts, it's firefighters. Life insurance isn't usually at the top of the list, but just kind of give you a little bit brief background is I got into the insurance industry right out of college back in 2006. Okay. And I was basically recruited by a Farmers Insurance to sell insurance to my friends and family, and quickly realized that wasn't my career path for a few reasons. Number one is, when you're working with a career or captive insurance company, you're required to sell their particular products. And, I don't necessarily like being handcuffed and only being able to offer one insurance company when there are literally dozens or hundreds of insurance companies across the country. And second is I realized that, sales just weren't for me, and that's okay. What I did really enjoy was really putting the pieces together and doing all the analytical work behind the scenes of creating a complete, comprehensive financial plan, incorporating investments, incorporating annuities when appropriate, life insurance strategies when they're needed, and not to mention long-term care and disability, creating an estate plan that can, last generations when done properly and executed. So, that's sort of what got me in the industry. As far as today, currently, I work for a brokerage agency here in San Diego, and we basically work with independent financial advisors like Jamin all across the country, and we work with 60 plus insurance companies. And my job, when Jamin has clients or prospects that he is looking to implement some of the strategies that we'll discuss today, is I shop around, all 60 companies, try to find out the absolute best product for their unique financial goals, and more importantly, deliver in such a way where it's not just about the product; it's more about the strategy and how to actually use a strategy to accomplish those financial goals.
Sure. And I think you're right. I don't think there are many kids out there that are like, I want to be an insurance agent, or I want to deal with life insurance. It's kind of a unique thing to get into, but from how much you've helped our clients, I'm glad you got into it. So I appreciate it.
Thank you.
But I think the other day you also mentioned to me a story about, I believe it was your uncle that kind of, pushed you along into this direction. Would you mind sharing that with everybody here?
Yeah. So this goes back probably to the mid late 90s, and to kind of give you a little bit brief background, my uncle he's a great guy. He did get divorced a few years prior, and he was living with his new wife in his home, and was getting into his late 50s, and want to make sure his affairs were in order in case something happened. And so he got a will, put a will and trust together. And in the will, it specified that should he pass away, that his wife that he lives with today stays in that house that they live in. He wanted to make sure that she was comfortable, she had the house, place to live, and basically, all the memories that they've built together, they can continue to have that in that house. Now, he had 3 kids that were about in college age, and he didn't want to disinherit them financially. He wanted to make sure that they had the best start in life as well. And so he basically left in the will life insurance. And just so, again, he didn't want to create any family drama. New wife gets the house, kids get the insurance. Well, unfortunately, what happened is my uncle passed away. And it was unexpected. It was one of those things where, just out of the blue, got the call, and believe it or not, it was actually the first time I saw my dad cry. I was 10 years old, and he had to deliver the news to my grandmother, his mom. And when they were going through my uncle's office, they found the will. Fortunately, that sometimes can be hard when you're going through that process. And what they also found surprised them. They found a life insurance application, not an actual policy. No. So, he had all the best intentions. He wanted to make sure that everyone was taken care of. Unfortunately, the kids did not get the life insurance because it didn't exist. He didn't follow through with the plan, and ultimately it created not only emotional stress for the kids, my cousins, but it also created a lot of family issues. They went to litigation, and it was just created all kinds of these financial and emotional problems. So I saw firsthand that not having life insurance can create when someone passes unexpectedly. So saw that firsthand, and want to make sure that my family members, friends, clients, people across the country don't find themselves in that same situation. Sure.
And that's kind of common use, right, of life insurance, and that's kind of what everybody sees life insurance as, is that death benefit, that that money that passes on, the benefit that your beneficiaries get, but you don't really get to take advantage while you're alive. One of the things, or a lot of what we're going to talk about today, is how to use life insurance while you are alive, and changing kind of the mentality when it comes to life insurance of, look, it's more than just a death benefit, or it could be more than just a death benefit if used properly. I think, when you and I were getting ready for this and talking about this the other day, one of the things that surprised me, which I didn't know about, was we were talking about the general idea of how the general public views life insurance versus how the wealthy use life insurance. And, you mentioned this to me, it's the story about Elon Musk. And I'm not sure I 100% understand it. Otherwise, I'd tell the story. But can you explain exactly what it was that Elon Musk did when he was buying Twitter? Yeah.
So I think this goes back. Let's separate life insurance for a second here, but just talk about how the wealthy use money. It's different than how the general public use it, like you mentioned. Is if let's say guys like Elon Musk want to buy Twitter for, I think it was $40 billion, he has a couple different options. He can sell an appreciating asset, like let's just say his Tesla shares, for example, pay capital gains at a pretty punitive rate at that his income level, lose the opportunity costs on what the future growth of that stock may do to basically make that investment. Or he can use a strategy called buy, borrow, die. And this is a strategy that the wealthy use, have been using it for centuries, is rather than depleting highly appreciated assets, paying taxes and losing opportunity costs, you instead borrow against those assets on a favorable tax-free basis. So for example, Elon Musk could go to an investment bank and use his Tesla stock as collateral, borrow against that stock at a favorable basis, which by the way is tax-free, to purchase an asset like Twitter, and he still retains the Tesla stock that can appreciate over time. Additionally, in the tax code, there's something called step up in basis. So he could continue this process of collateralizing an asset, like stock, for example, on a tax-free basis, and then pass away with those assets, which ultimately are transferred tax-free due to that step up in basis law. Sure. Now, that sounds somewhat complicated and maybe not something that the everyday folk would implement. They don't have the scale, the billions of dollars like Elon Musk has, but we can actually do the exact same thing that the wealthy use, the strategy called buy, borrow, die, using life insurance. Again, not for the death benefit, but more for the ability to collateralize an asset on a tax-free and favorable basis, still being able to participate in the gains of the policy, but being able to use that liquidity for outside purchases, whether it's a business, real estate, purchasing potentially stock at discounted prices, whatever that may be. And, I think one of the things I realized, not only is life insurance, I think, crucially important for families, but I also think something else is important is liquidity. And you've always heard the expression cash is king. I really think liquidity is king. Whether it was COVID, like we had this very sharp temporary pullback in the stock market, real estate market, and then an explosion upwards. And, 200% rally since then in the U.S. stock exchange. And the reality is we don't know when the next recession will hit, but the economy works in cycles. There will be recessions, and having liquidity allows you to take advantage of opportunities when they come your way.
So using strategies like that, I don't think anybody in this call, and I don't think you or myself are Elon Musk level of assets, but using something like this, and I know I've had clients use the idea before to purchase homes, whether it's going to be an investment property or, fix and flip type deal, but borrowing money against other assets like a life insurance policy to go out and buy these properties. Is that something that you see that's pretty common because obviously I see what my clients are doing, but you get to see, working with a lot of advisors, a multiple of clients that I see. So is that a strategy that you see is fairly common with people? Is that buy, borrow, die?
Yeah, I think when they have the right coach is the right coach, not only to be able to set these up properly to start, but also to help coach them along the way on how to use them effectively. And I'll kind of give you a couple examples just
Sure.
So the listeners can kind of get an idea of how this would work, both personal stories and as well just what I've seen with clients across the country. So like this last cycle that we're kind of tailing end off is we've had very high borrowing costs, right? Like at one point, the 30-year fixed mortgage was at 8%. HELOC rates were at 8-9%. Hard money line type loans were in the 20% plus range. Obviously, very punitive to access money in a high interest rate environment. And we've actually had clients who had cash value life insurance with contractual guarantees at 5%, meaning that the rate that the insurance company can charge to access money using their life insurance policy as collateral can never be greater than 5%. So while other people were trying to get HELOCs at 8-9%, which require qualification first and foremost, so you have to prove to the bank you have the ability to pay them back. They require credit checks. They require specified payment terms, whether it's you got to pay each month's interest. If you don't, you forfeit the collateral, your asset. With the life insurance policy, we saw clients take advantage of depressed real estate prices, be able to buy at borrow at 5%, no credit checks, no set payment periods. Like you can let the loan balance continue to accrue without paying any interest at all. You can pay interest, you can pay the principal and interest, all within.
Sounds like a lot more flexible of a loan.
Way more flexibility than going to a traditional bank, and oftentimes much better interest rates as well.
And correct me if I'm wrong here, which when you borrow against a whole life policy or an IUL policy or any sort of policy, while you are paying the interest, they are also earning money, right? And so it's because you're not technically borrowing from your life insurance cash value, right? You're using that as collateral to borrow from the bank or to borrow from the insurance company, correct?
100% correct. And that's a common misconception we often hear the phrase, you're borrowing from your policy. You're actually borrowing from the insurance company with your policy as collateral. And you mentioned a really, I think, key difference with a lot of these more modern type policies is you're not actually forfeiting the ability for that amount you borrow to, you're not sacrificing future returns. We call it, basically the loan balance continues to participate in the returns of the contract, which over time we've seen returns between 6 to 8% on a fairly consistent basis. So if you think about it, being able to borrow for a real estate transaction at 5%, all while your money is still within the policy, you're not physically removing it from the insurance company, you're borrowing against it and earning potentially 6 to 8%, sometimes even double digits in great years. So you're earning the appreciation on the property you purchased, but also the appreciation of the policy itself.
So you're essentially using collateral to get let's call it a 5% loan, making, let's say, an average of 7% from the numbers you gave. So you're making 2% on that money, plus the loan, whatever you're invested in, whatever money it's making, whatever you put it to work to do, whether that's buying stock or buying real estate or buying whatever. You've now got one way of looking at it is you've got the same dollar working for you twice on two different sides.
Great way to put it. And maybe putting it into more practical terms, I'll kind of tell you a little bit about, I think we talked about this, Jamin, like what I did in the past. So I'll kind of go back to, it was like February, March 2020. And we're sort of we didn't really know what was going on. We all heard about COVID. And I remember actually talking to one of my coworkers, and he was saying Europe was starting to shut down, and his brother was in defense, and he mentioned they might impose lockdowns in the United States. I told him there's no way that's going to happen, and literally 3 weeks later it happened, and the stock market fell about 35% in roughly a month time frame. And a lot of people were scared. There's obviously a new virus out there. There was a lot of panic, but I saw opportunity. And fortunately, I started one of these policies back in 2010. I built up significant cash value in two contracts at the time, and I borrowed from the insurance company using my cash value as collateral. Was able to purchase high quality stocks like Tesla, not to bring up Elon Musk twice, but companies like Tesla, Peloton, Zoom, all those pandemic type stocks, severely discounted. Was able to create multiples of my money in a short time frame. I didn't master the sell quite perfectly. I mastered the buy. Ended up making still a really nice profit, and then paying back the loan to the insurance company, all while my life insurance policy earned about 10% in that same year. And by the way, that my particular policy has a variable loan, and the variable loan rate at that time was 2.5%. So it wasn't even the 5% that some clients are getting. So it ended up working out well. Now it's not going to just, as you mentioned at the start, you don't go rush off and do this because, you can't always that was a once in a lifetime type opportunity. But I think going back to my main point is I learned one of my biggest lessons is that not cash, but liquidity is king, and having liquidity allows you to take advantage of opportunities when they come your way.
Sure, absolutely. And I mean, and it doesn't matter, we keep mentioning Elon Musk, but you don't have to be Elon Musk to do this. I mean, obviously Brian's done it a couple of times in his life, and I've got a number of clients that have done it. And so it's one of those things that if the opportunity presents itself and you're in a position to create that liquidity, then you get to take advantage of the opportunity. And so this policy that you're talking about or this strategy, is it a specific type of life insurance, or are there multiple types that fit under this umbrella or this strategy? What exactly is it that you're talking about there?
Yeah, good question. So kind of going back to my old career days is you'll have certain advisors who are whole life guys or IUL guys or gals. We're a brokerage agency, so we offer products all across the risk spectrum. So the way I view life insurance is maybe different from a career advisor who only has a certain amount of. But the product I was mentioning was indexed universal life. Now, indexed universal life is, I would say, more of a moderate risk tolerance type product. The same strategy could be used with whole life. Now, whole life has more contractual guarantees but less upside. So part of my job is to understand the customer, like what's their risk tolerance, what their financial goals are. But ultimately, IUL tends to fit well for both flexibility on premiums, transparency on expenses, favor. Still guarantees with a 0% annual floor. So like if the market does fall 20% for whatever reason, you're not losing value because of the stock market decline, but you still have the opportunity for upside returns in the stock market up to a limiting factor like a cap rate or participation rate.
Okay. And so this is a strategy that it really doesn't matter necessarily how much in assets that you have. You just scale it a little differently. I mean, you can just scale it to whatever level that you're currently at.
Yeah, and just to kind of give you my personal story is when I first started my IUL. I want to make sure I was diversified. I want to make sure that I had money in the stock market, and I want to make sure I wasn't putting all my eggs in one basket. So I was still contributing to my 401k at work, still max funding my IRA, but I wanted to put additional money aside for accessibility, life insurance, and $450 a month at that point in time in 2010. That was my budget, and so to your point is that was definitely a little bit below the Elon Musk levels, but that was my level, and I made it work. And as my career progressed and my income increased, I started actually a second one in 2013 at a higher premium. And then here in the last 2 years, a third one as well with a much higher premium. So again, to your point, it's all scalable. $500 a month for someone in their 20s is fine. But as you start building and progressing your career, it's based on your financial plan and what works for you.
And this is all a way of just leveraging your current assets, leveraging your possible income or assets, and just multiplying the use of them. Not just for the death benefit, but now you've got liquidity to go out and do some of these other, take advantage of all these other opportunities. So you're essentially, this is all leveraging your own money, correct? I mean, you're not necessarily borrowing. I mean, you borrow from the insurance company, but it's against the collateral of your own money, your own life insurance policy. Yeah.
There's really two types of leverage, I would say, when purchasing an IUL. One is what we've been talking about, is being able to borrow from the insurance company using your values as collateral and leverage those dollars to purchase other appreciating assets. So that's sort of one way. The other way is, I think, a little more sophisticated and for probably somebody in a higher income and net worth category, but it's something where we could actually borrow from a very specialized bank to basically pay for a portion of the premiums. So you're getting leverage from from a bank, for instance,
Mm-hmm.
to basically pay a portion of your premiums. And we do this a lot, actually, for a couple different reasons. Number one, the wealthy, I think, understand that leverage, when done appropriately, can amplify the outcomes. And number two, we also use it from an estate planning standpoint. And I'll kind of, if you don't mind, Jamin, talk a little bit about that. So a couple things on the estate planning side is there's a law called the Tax Cuts and Jobs Act. It was passed in 2017, implemented in 2018, and it sunsets, believe it or not, in about 16 months.
Mm-hmm.
In 2026, a lot of things are going to change. Standard deduction is going to go down. The marginal tax brackets and rates are going to go up. In addition, the unified credit is going to basically cut in half. And that unified credit right now, as it sits today, is about $26 million per couple. So most wealthy clients and individuals, they may think, well, I don't have a tax problem, a state tax problem today, but we're all going to wake up, hopefully not a hangover in January 1st, 2026. And most of us are all going to owe more taxes. Specifically on the estate planning side, we've been able to help mitigate some of those future changes. And one of those is using life insurance to basically provide a tax-free asset outside the estate, and oftentimes using bank-funded premiums.
Mm-hmm.
And sort of to talk about that a little bit, is the laws are very set in stone in that I can't just pay the premiums into the life insurance policy. They actually have to be gifted to an irrevocable life insurance trust, and the irrevocable life insurance trust, ILIT, is the one purchasing the policy. There are very specified IRS limits on how much I can gift to any single person. And, if I only have, let's say, a few handfuls of beneficiaries for my estate, there's very limited room for me to make a large premium gifts to the ILIT to purchase life insurance needed to cover estate taxes. With financing, the way it works is the ILIT is actually borrowing from the bank to pay for the premiums. So it ends up being very, very much gift tax friendly, as you're not paying these six-figure premiums out of your pocket. You're instead using bank financing to make the premiums on your behalf.
So just to try to clarify that a little bit, when you're using this strategy where you're using bank financing, so it's the same strategy and idea we were talking about earlier with, say, an IUL or a whole life, except you're paying part of the premium and then the bank is also pitching in part of the premium. So if you were going to do it on your own and you said, hey, I can afford $10,000 a year in life insurance premium, you can either do it on your own or you get the bank to join in, and now you're putting in $10,000 and the bank's putting in $10,000. Is that how it works? So you've actually got double the premium going in?
Yeah, and actually one of the programs we work with, they do a 3x leverage.
Oh, wow.
So think about it this way: if you're contributing, it's on a 5-pay period. So let's say you are contributing $20,000 a year for 5 years, total of $100,000. The bank's going to kick in another $200,000. So basically $300,000 are working for you for your $100,000 in premiums. And so, yeah, you get a lot more working for you. Now, there are pros and cons. So it is a loan. So, there's going to be some collateral requirements. This particular type of design, the cash value of the policy is the sole collateral source. So you don't have to post any additional outside collateral. And then once we get to a point where the policy is sufficiently funded, we can actually take one of those participating loans against our life insurance company to pay off the bank. And so now there's no more bank involved in the transaction. And so we've done this for everything from just everyday people like you and I who want to amplify our insurance and retirement plan. We do this a lot in the corporate world as well, specifically for executive benefits, where it still is a tight job market. I mean, inflation's keeping up a little bit, but job market's still tight. And and unfortunately, the way the world has worked, specifically over the last 10, 20 years, is people jump around careers a lot from one firm to the next, whether doesn't matter what type of industry you are. So retention is a really big issue for a lot of employers. And this is a great strategy for not only to recruit high quality people into your firm, but also reward those who are, your key employees, and also retain them as well. We've had a lot of great success implementing these for both big and small companies. Again, for those three main reasons: recruit, retain, and reward key employees.
Yeah, and I do want to dive into, we've gone through quite a bit on the personal side and what you can do there. I want to dive into the business owners and the business side and how they can use life insurance as well. But I'm going to rewind just real quickly here, because if you guys have watched these webinars before, you may have seen Don Henderson on here. He's the estate planning attorney that we have in the office. He actually just chimed in on that ILIT, the irrevocable life insurance trust that you talked about. Mm-hmm. He wanted to add a caveat that you do need to be extra careful in community property states like Texas to ensure that separate property funds are used to fund the ILIT to avoid accidental inclusion of life insurance trust in the gross estate of a married couple, because then you'd be defeating the purpose of actually the entire strategy that you're trying to put in place. So, Don, thank you for that. Thank you for chiming in there. And this is why we tell everybody that today's for informational purposes only. Please don't go out and take anything that we're saying and try to implement it on your own. Make sure that A, it fits with your financial plan. B, that you've got, if you're doing this for estate planning reasons, that you've got an estate planning attorney looking over everything so you're not coming across something like that. Because most financial advisors, most life insurance experts aren't going to break down the legality of everything as well. So there are multiple, we talked about earlier, the cogs in a wheel. When you spin one, it affects something else. You've got to make sure this not only fits your financial plan, but also it legally handles exactly what you need to do when you're talking about your estate. So just wanted to throw that in there real quick, because I know that Don sent that message over, and he wants to make sure that everybody's taken care of when you're setting something up for a specific strategy, that it gets used properly without screwing up something else.
Yeah, great to have the right professionals in your team, in your corner, to make sure the life insurance person, the financial person, and the estate planning attorney all working together for the common goal of the client. Absolutely.
Yeah. And that's why, we're so fortunate that we do have a good estate planning attorney here in the office that kind of checks over all of our estate plans that we do to make sure that something like that doesn't get overlooked. So glad to have him here and joining in as well to let us know that kind of stuff. But kind of back to what you were talking about is with that strategy where you're multiplying using the leverage of the banks, that kind of feeds into, you mentioned, what was the right terminology for their, like the golden handcuffs for those key employees. Yeah. Can you explain how that policy would work for a business owner that's trying to retain or try to attract a specific key man or key woman policy there?
Totally. Yeah. And this is one of the things where, you run a business, we run a business as well. And there's only so many dollars, right, that you have discretionary after you paid all your expenses. You have to be very efficient with how those dollars are spent. And what we like about this specific strategy is what you just said is the multiplication of those dollars. We get more use out of each dollar, not only just the retirement aspect, but also the life insurance, whether it's for key man purposes or maybe for the spouse of the employee. A lot of these policies also have living benefits, such as critical, chronic illness type riders that come along for the ride. Because let's be honest, everyone talks about wanting or needing disability insurance in case something happens, but not a lot of people want to pay for it. So having these additional features allows you to get more benefits for the dollars that the company is funding. Now, as far as like how to implement one of these types of strategies, I think first and foremost, it's selection. So this is a non-ERISA plan. So you don't have to offer this to all employees. This would be offered to key employees of the company, including the owner, potentially themselves. Mm-hmm. And oftentimes we'll use what's called an executive bonus IRS Section 162, where essentially the company is the one paying for the premiums, and they're doing it via compensation. So the company would get a tax write-off for the premiums paid, just like they would by paying salary. Mm-hmm. The employee is going to pay taxes on those bonuses, just like you would from your regular paycheck. But the employee is going to own the life insurance policy. They have all rights to name the beneficiary, their spouse, their kids, their trust. And you can add something called a restricted executive benefit arrangement to this transaction. You mentioned it, a golden handcuff. Mm-hmm. Essentially, that's what that would be. It allows the company to place certain requirements on the employee to be able to access money from the policy. And so, I mean, I think this is a great tool from a management perspective. I manage a team over here at our firm. And if I were to go to my employees and tell them, you guys have been doing great, guys and gals, in growing our company. I've hand selected you as people that I want to reward and retain. Here's what we're going to do is we're going to pay premiums for 5 years into this policy. You're going to have to pay taxes on the contributions. And you can't access the money for at least 5 years. That's a golden handcuff. This tells me as the manager and as the employer, is this person going to stick around for 5 years? Because if they're wishy-washy on like, I don't know if this is something I want, I don't know if that's the person I want on my team. Yeah. So I think from a management perspective, I like the ability to, again, recruit, retain, reward my employees, but also using this as a gauge to like how committed are my employees to the success of our firm, and ultimately how committed are they to us as well.
For sure. And, I think you also mentioned to me the other day about the way that actually the founder of your company used this life insurance within your business. And so it's one of those, practice what you preach type of things where the founder of your company actually used the strategies that we're talking about here. Can you explain exactly how that kind of went down?
Yeah. And I'm actually in his office right now. He passed away in 2021 from ALS, and he started our firm in 1986 in his garage with a door taken off the hinges and those the pony wall things and a phone, and that's how we started our company, and grew it to it's a very successful firm over 35 plus years before he passed. And he didn't have any kids. It was him and his wife. His wife wasn't involved in our business. She was a really phenomenal woman, not involved with our company. And, it was one of those things where he had this very specific intent, right? Like, just like my uncle we talked about earlier in the call, he had a very specific intent for us, the key employees of the firm, to continue the torch, or to pick up the torch when he passed, and continue this mission of helping people all across the country. And he left us essentially the company. However, he also didn't want to disinherit his wife. And so essentially what he did is with an attorney, like Don, he set up essentially a non-qualified ESOP, where after each employee gets to 5 years, they get shares in our firm. So I had stock in our company as early as 2012. I started in 2007, and certain actions you can get more shares, basically. Now, in order to complete the plan, because if let's say he was like my uncle and created this great plan, but didn't actually do the follow through, what would end up happening is his spouse would end up being our boss, right? And which she didn't want, we didn't want. So he bought a permanent life insurance policy. We bought it, the company bought it on his life. And when he passed, what ended up happening is we used the life insurance proceeds to buy out Gail, his wife's shares, So us as employees retained ownership of the firm, and we're able to, again, carry that torch into the next generation. And, it's just one of those things where the intent was met with follow through. We had all the right people on his legal team to make sure this transaction worked. And, lo and behold, we're still here today, even though he passed away 3 years ago.
Yeah. That's an awesome story. And then that just kind of shows you the power of using life insurance in the correct way for a specific purpose, for a specific plan. And so we've kind of gone through talking about life insurance as a death benefit with your uncle. We talked about using life insurance and leveraging your assets to create kind of another growing asset that, if used properly, is tax-free income that you can draw out of or borrow from, and then take advantage of other opportunities. We took that a step further and said, hey, we're going to leverage our own money, but now we're also going to leverage the bank's money and multiply this same strategy, but we're going to use somebody else's money to multiply it. And then we talked about how you could use that on both the personal side as well as the business side for a business owner, then go into business strategies such as, retention or attracting new key employees or whatever it may be. And one thing we did kind of skip through real quick is just your typical key man insurance. With or key person insurance, I guess I should say, is when it comes to that nowadays, I've seen people, suggest using IULs for key person insurance. Traditionally it's always been term insurance, right? And so my question to you is, from your opinion, from what you've seen, when you're looking at key person insurance, trying to benefit your business, is that a situation where you'd use an IUL? I just hadn't seen that before. I recently saw it, so I'm just kind of curious on that. Yeah,
really great lead in, and we had a situation arise just 2 weeks ago where basically someone was pitched IUL for the purpose of key man insurance, and I think this goes back to exactly what you said is you want to match the product and strategy to the actual need itself, so for key person insurance, I'm 42, and I plan to be here for at least 20 more years. So if my company wanted to make sure that the business would continue to grow and succeed long after my passing, and that was a primary purpose, was the key person, 20-year term policy would do just fine. It's going to be inexpensive. It's going to allow the business to retain more capital, invest that in areas that they want to invest in, or whatever that may be. And I think a lot of insurance agents out there, they always talk negatively about term insurance. I don't view that at all. I think it's finding out the exact need of what the client's looking for. Term's great. I mean, I mentioned I have IUL. I didn't talk about it. I have 2 term policies too. And I view the term as protection if I'm the breadwinner of the household, and if I don't make it home tonight, I want my wife and kids to be taken care of, and I don't want them to I want them to stay in the home. I want my girls to go to college. I don't want them to make any sacrifices. Term insurance is a great solution for that, but at the same time, I also want to make sure that I have liquidity to take advantage of opportunities and continue to grow and build over time. So going back to the question about the key man is, again, match the product to the exact need. And in the case that we were working on, they needed term insurance. Yeah. And the other advisor, they recommended a really large IUL policy. And if you don't mind, I'll talk a little bit about compensation. Do you think that's appropriate without getting any specifics?
Yeah, I mean, we've got about 4 minutes until the time that we told everybody we'd be done. So after that 4 minutes, my goal is to then start getting to the question and answers that everybody's got. We've got a handful of questions here, but yeah, you've got the next 4 minutes to tell a story.
Great. Yeah. So, and this is, I think, a little unique in that a lot of people like you and I wouldn't share this more on a public setting like this. I think it's really, really important for consumers to understand what they're getting into when purchasing life insurance. Is like when you go to a car dealer and you see the sticker on the window, you don't know exactly like what you see the price, but you don't know what's the actual margin that the dealer's getting or the salesperson what they're getting. Sure. And you see it's the same thing in the insurance industry. Is certain products pay different compensation based on the product type, based on the structure. And in that specific case we're working on, the advisor would have made well over $30,000 on a single policy, where I think the commission on the product we recommended was about $1,000. Yeah. So, I mean, it was one of those things where we put the client's best interest ahead of our own, and that's how it should be. Is advisors looking out for the best interest of the client, regardless of compensation. And that was a situation where term was appropriate. The other advisor positioned permanent insurance way where he was going to get a really large commission where he didn't need to, based on what the client was looking for.
Well, I thought not humorous. The sad thing about that whole ordeal was we even wanted to compare apples to apples, right? And we looked at doing the exact same type of policy that he put together, but structuring it properly. And rather than a $38,000 paycheck or whatever it was that he was going to get on that, ours was like 13. It was a third of the commission, but the client ended up getting $1 million more in benefit. So it just kind of speaks to making sure that you put the right product structured the right way for the right reason. So yeah, we've gone through quite a bit here. We've gone through a couple of different strategies. We've gone through a couple of different iterations of each strategy. But there's obviously a ton more that we could go into today. Told everybody, this would be about an hour. We'd be done by 1:30 Central, which we're right at right now. So what I want to do is I just kind of want to open this up to Q&A. This is your chance to ask myself, ask Brian, any questions that you've got on life insurance. If it's something specific, like a specific policy that you own, we'll deal with that kind of afterwards. And we can talk about that on a more one-to-one level. But if you have any, strategy ideas or thoughts or something you've been told that you want to get clarified, now's the time to ask. I also want to let everybody know that if you look to the right again, there should be a section in the offers for you to sign up for a consultation. It's just a 30-minute phone call with me. That if you want to get your specific questions answered on life insurance or anything else for that matter, you have the ability to do that right there. But let's start getting into some of these questions. The first one here that I got from Brian, different Brian. What is a good way or place to start with someone that's just starting out, i.e. someone in their early 20s? And I think you mentioned even that, at that level you were starting out with an IUL at $400 a month or whatever it was, right? Yeah.
Really, really great question. And Brian, thank you for tuning in. I think the big thing I want to put out there is that compound interest is your friend, and starting now is going to be a huge benefit for someone starting in their 30s and 40s. So regardless of if you're looking at IUL or Roths or your 401k, your employer, for instance, start young. And if you can, be aggressive with your savings rate. But at the same time, if you're locking all your money into your company 401k, which again, the great vehicles for retirement planning, that may limit your ability, your access and liquidity in times where you could otherwise have opportunities like a real estate downturn or whatnot. So in general, again, this is not specific investment advice, but 401k match, that's your friend. Roth IRAs, those are great. IUL could potentially be something to talk about as well. And generally speaking, about $400 or $500 a month would be enough to keep the expenses efficient and get you a good policy. Again, compound interest is your friend, and you're at a great age to start saving. And I commend you for even being on here to start.
And so you hear a lot about on TV and anywhere else that you read about investments, you hear a lot about diversification and the importance of diversification, but you normally hear about it in the context of diversifying between stocks and bonds. Mm-hmm. You know, one of the things that I try to emphasize with everybody is diversifying in a multitude of ways, not just stocks and bonds. You can even go deeper into stocks and saying the type of stocks that you get, deeper into bonds, the type of bonds you get. But then you also need to back out and say, okay, diversify in what type of accounts I have. And these can be from a standpoint of liquidity, like Brian's been talking about. They could also be from a standpoint of taxation. So you've got your taxable buckets, your tax deferred buckets, and your tax free buckets. Without knowing where tax rates are going to be when you retire, I mean, you know, if you're in your 20s, the best thing you can do is get diversified amongst all three of those buckets, because then you have flexibility in retirement or when you near retirement to draw from the correct place at the correct time to keep your tax brackets as low as you possibly can. So diversifying not just the type of assets, but the type of tax accounts that you're in can be huge. And you know, as Brian mentioned, diversifying against things that are more locked in, you know, like an IRA or like a 401k, to things that are more liquid, like a brokerage account or an IUL, for example. So you can diversify your liquidity as well as your taxes, as well as your investments. So I personally think it's very important to do all three of those.
Really, though, great points. Really good points there.
Tony. Yep, Tony says, assuming you do not need Social Security to live on, do you see people using their monthly Social Security payments to fund an IUL as a way to diversify?
Yeah.
Right, you've probably seen more of these different scenarios than I have. So
Yeah. So there's a couple of things I want to mention before we even talk about IUL there. Is Social Security timing is crucially important. So, for example, if you were to look at your Social Security payment at full retirement age, which for most people is going to be 67, versus your Social Security payment if you delay to 70, the max level, there's what's called a deferred income credit from those 3 years at 8% per year, guaranteed by the government, plus the COLA, the cost of living adjustment that they throw on. So essentially, you're getting a guarantee from the government, 10% return, give or take, for those 3 years of delaying from 67 to 70. So one thing I want to throw out there is I wouldn't file for Social Security early and get a permanently reduced benefit to fund an IUL, just because the economics of delaying Social Security are greater than the interest that we can reasonably earn by filing early and funding those premiums in the life policy. So if you have already filed for Social Security and you're receiving the payments today and don't need those for income, I would go take it a step further. Is if you're in retirement and have excess cash flow, whether it's from pension, Social Security, or annuity, you basically have two options, or three, I should say. Number one, spend it. All right, like it's your income, enjoy it, spend it. Number two is give it away, whether that's gifting to kids or gifting to charity. Number three is saving it. And so I think if you're in a position when you're in retirement and you have more income than you need, and also maybe RMDs down the line at either 73 or 75, creating additional income that you don't need, those are absolute situations where we have clients who use that excess income to fund life insurance. It's often done a little bit differently. So the costs, kind of getting into the weeds a little bit, the costs can be more prohibitive on these policies the older you get. So oftentimes we'll use a survivorship chassis, which is a joint life policy where we insure both spouses. That will keep the life insurance expenses lower and provide more benefit for the dollar. The other way we'll potentially do it is not even look at IUL, and we'll look at something with a contractual guarantee, like a guaranteed universal life policy, maybe even a whole life, where we're not buying the least amount of death benefit that the IRS will allow and building for cash value, but instead we buy the most amount of guaranteed life insurance that the insurance company will offer. And that way we are doing it more for that traditional death insurance, so to speak, less for cash value. So a lot to unpack there, but I guess to directly answer the question, Social Security timing is important. Work with your financial advisor. If you're in retirement and have excess income, spend, give away, save. And if you're in that third category being save, life insurance could be an option, and there are multiple ways to do it.
Yeah, Tony, I think it has a lot to do with what you're wanting to use that money for. Like, if you're going to buy an IUL, why? Like, what's your purpose for that? Is it for 100%. You, for your cash purposes? You can also buy a policy on somebody else, and rather than gift them $1,000, you can gift them $1,000 a year or a month or whatever it may be into a life insurance policy to basically leverage that gift towards them. So it's just, there's a lot of different ways to do it. It just kind of depends on what your purpose is for that. And then, a little quick plug here on the Social Security. If you guys want to learn more about that, you can go to our website. We've got a webinar sitting up there. It's a little bit old. It's from 22, I believe. We are going to redo it this year, but it's the same information. Numbers have changed slightly, but if you want more information on Social Security, we've got a webinar up on our website about that. Doris, what is an IUL? It is an Indexed Universal Life Insurance. So it's a type of life insurance policy that has an investment vehicle built inside of it, basically.
Yeah. One thing I'll kind of add there too on the IUL side, in Indexed Universal Life, is the mechanics of how it works is I would think a little bit unique to how other policies work. So for example, there's something called a VUL, V as in Victor, which stands for a variable universal life. And your cash value is actually invested in sub-accounts, which are specific mutual funds within that are offered by the insurance company. And your cash value will go up and down based on the stock market. Indexed Universal Life, IUL, is a little bit different, where you're going to have a floor of 0% generally. Sometimes there'll be a 1% floor, meaning if the stock market goes down 10, 15, 20%, you're going to get that contractual guarantee of 0 or 1. But the trade-off to having downside protection is you're not going to have unlimited upside on the stock market performance. You're going to have some sort of limiting factor like a cap or participation rate. So for example, a cap would be like 12%. So if the S&P goes up 15% or 20%, you're only going to get 12%, not the 15 or 20. As far as participation rate, right now you can get about an 80% participation rate. So the S&P goes up 10%, you get 80% of that, or 8%. Again, trade-off being stock market goes down 10%, you're getting that 1 or the 0% floor.
Yeah, there's a lot of ways to build these, all these policies. There's a lot of ways to build them. There's a lot of ways to set up your investments. And I think the key takeaway here for everybody should be, what is the purpose? Why are you wanting to get into this? Or why do you think it's a good idea? What is your purpose? Because between Brian and myself, we can create the right strategy if we know the purpose that you're going after here. Brian, I had another question come in actually before we started via email that says, how can life insurance be used to mitigate estate taxes and or ensure liquidity for my estate?
Yeah, great question. So I'll handle each of those separately.
Okay.
So the first part being liquidity. If right now, as the law stands today, again, the exemption is fairly high at roughly $26 million per couple, but it's set to cut in half in 2026. Let's just call it roughly 13, 14 million per couple. So every dollar over and above that is going to be taxed to your beneficiaries at a marginal rate up to 40%. So if you have a net worth of $30 million, for instance, and 16 of that is exposed to estate taxes, that could be a pretty nasty estate tax bill. And by the way, the IRS doesn't say pay us whenever. There's a very strict time frame on when they want the money, and I believe it's 9 months post mortem. So they need the money, and they need the money quick. And a lot of high net worth clients, they don't hold all their assets in the bank account. They have money tied up in real estate and privately held businesses, stuff that can't be easily converted to cash. So on the liquidity side, if that event happens and there's an estate tax bill due, oftentimes beneficiaries without life insurance have to potentially fire sell assets at a discount to pay the estate taxes or borrow money to pay the IRS. So they're not paying $10 million in estate taxes, they're paying $15 million with interest. Having the life insurance held outside the estate will allow beneficiaries to use the insurance company money to pay the IRS and keep those highly appreciated assets in the family for future generations. As far as the structure itself, again, Don, your estate planning attorney, can get more into the details, but generally the life insurance is owned within inside of a irrevocable life insurance trust, ILIT for short. The ILIT is the owner, ILIT is a beneficiary, and it's basically a way for the grantor, the person who sets it up, to control the money from the grave. They can set specified terms on how money can be accessed. I want the money to go towards estate taxes, to educational expenses, to grandkids. You can only take out interest, not the principal. So I want to preserve the money for future generations. Having a great estate planning attorney in your corner is really crucial to set those up correctly.
I got a handful of questions here prior to starting, but they are pretty general. So I'm going to read a couple of these, but just to let you guys know, if this is one of the questions that you asked and you sent over to me, let's get together offline and see what exactly your scenario is, because these types of questions are a little too broad for us to answer right here without knowing more specifics. What is the best life insurance policy for me to get as a retiree? Again, it's going to depend on your scenario, your situation, what you're trying to do with it. How can I have more than one, or can I have more than one life insurance policy? Yes, yeah. I think Brian proved that. He's got a half a dozen of them. You can definitely do that. When I borrow money from my life insurance policy, is it taxable? Good question.
Yeah, great question. Yeah, tax free. And actually, if you look at your tax return, there's life insurance loans is not listed on your 1040. And it's just like if you were to borrow money from a bank to buy a car. Mm-hmm. If I was to go to down the street to buy a car off the lot and I get a bank loan from them, that loan isn't taxable to me. They're lending me money. Same thing is true on a reverse mortgage, reverse mortgage line of credit. Loans are generally tax-free, and that's what this is. It's a loan from the insurance company with their life insurance cash value and death benefit as collateral. When done properly, it's tax-free. Now, there's certain limitations, the IRS limits, not to bore everybody, but if you set these up improperly, you could actually create what's called a modified endowment contract, MEC, M-E-C for short, which actually could create situations where when you receive the money from the insurance company, all or a portion of it is taxable as ordinary income and also potentially penalized pre-59.5. So very important, again, as Jamin said at the start, don't just go running off and set these up without a qualified advisor, because there could be huge ramifications down the line.
Now, one caveat I want to throw in there and check my knowledge on this. Have you checked my knowledge on this? My understanding, and I'm pretty sure that if you borrow from, let's say, an IUL, you borrow from it, and then your policy gets to a point to where the policy can't pay the premiums, you don't pay the premiums, the policy lapses. Now that money that you borrowed is now, once was tax-free, is now taxable.
Yeah, I'm actually really glad you brought this up. And this is one of those things where I don't think there's enough transparency in our industry. And
definitely not.
And so just to kind of reiterate, your knowledge is absolutely correct. What that's called is called phantom income. And we've actually seen scenarios, unfortunately, where advisors either passed away or got in the business, got out of the business, did something else. Clients are orphaned without an advisor to coach them on their policy. The insurance companies are great, but they just process the paperwork. So they go ahead and borrow more money than the policy will support. And the policy, if over borrowed, could lapse due to what's called over indebtedness. If that does happen, the loan balance becomes taxable to the extent of the gain in the policy. So your cost basis would still be tax-free. The gain would be taxable. Again, ordinary income and pre-59 Act penalties. Now, the good news is two things. Number one is most modern-day policies have what's called an over-loan protection rider built-in standard to the policy. So those usually kick in at age 70 or 75. So if you ever get to a point where your policy is overloaned, you could flip on the rider, and it's going to create a reduced paid-up policy, no more premiums, no more loans, but it avoids that tax bill. And number two is, I can't say enough good things about you and all the great work you do for your clients. And we're relatively younger guys. We've been in the game for a while, and we're going to be in the game for a lot longer. I've been with our firm for 17 years. I'm 42 now. I have at least another couple decades to go. And probably, 5-10% of my day, honestly, is in-force service work. Because I want to make sure that the promises that we deliver to clients are promises that we keep. And whether that's change of address forms or processing loans or in-force illustrations, all stuff we help out with.
Absolutely. Brian, other Brian, viewer Brian, will this be on your website to rewatch later? So all of these that we do on a monthly basis are going to be added to our YouTube channel. There's a couple of them on there right now. You can find our YouTube channel on our website, or any email that I've ever sent out. Probably any email that you've ever received from us in the signature has the YouTube channel, or you just go to YouTube and look up Assurance Wealth Management. The three, I believe we have 3 on there so far. This one will be put on there. We are going to go through the process of cleaning them up and editing them to make them a little bit more presentable for you guys, and to take out a lot of the dead space or the information that's not relevant. But yes, you will also get a link via email to rewatch this. I'm not sure how long that stays open, but once that closes down, you just go to YouTube and you can probably find this video on there. We are actually in the process, starting next month, of putting out probably anywhere from 3 to 5 videos per month on YouTube, educational content like this. It's not going to all be an hour long. Some of it may only be like 10 minutes, but we're going to try to get as much of this information out to you guys as possible. I've had great feedback from all of these that we've done so far, that people want to see more, people want to get more informed, people want to get more educated on their financial lives. So that's what we're going to try to do. We're going to try to spit out as much of this information as we can, as often as we can to you guys. But of course, we want it to be presentable to you. So it does take us a little bit of time and production to do it. If we don't have any other questions, which it doesn't look like we do, please feel free to answer any more questions. We'll be here for another couple of minutes. Be happy to answer any of the questions that you've got. That's all we've got kind of on our docket right now for questions. I want to thank you guys all for coming. Again, if you'd like to get something addressed on your personal situation, please feel free to reach out to myself via email, via phone. You should have that information already when you signed up for this. You should have been getting emails from us. So please feel free to reach out at any point in time or set up an appointment. Be glad to help you with any situation that you have. I know Brian would be happy to sit down with me and go through a lot more of these strategy calls that we do. It seems like on a almost every other day basis now. So feel free again to reach out if you need any help with anything, but we're glad to help in any way that we can. Thank you guys for coming. Again, I think Brian and myself will stick around for a couple more minutes if anybody has any last-minute questions. But other than that, I think we're done. So thank you guys very much. And thank you, Brian, for helping out with all this.
Yeah, happy to do it. And, if there are more questions, we could always do another one of these too. I'd be happy to do that, whether it's diving into any specific topic, like we talked about estate planning, for instance, or executive benefits, key man, buy, sell, personal insurance, lot to go through in the insurance space. Even long-term care, it's a big one. If you'd ever gone through or seen that personally, a family member, friend, loved one, it's I've gone through it right now. My dad went through it with my grandmother, it's tough, financially and emotionally. And there's actually some really good products that actually can not only lock in your premium on a guaranteed basis, so you don't have to worry about it ever increasing, but also pay a death benefit as well for cost recovery, and also providing long-term care so you can stay in your house, don't have to go to a nursing home. So a lot of topics we can get into in the life insurance space.
Yeah, and I think we will. I mean, like I said, we're going to be putting out a lot of videos coming up here in the upcoming months. And I think the ones that we've had the most requests for as far as information are going to be advanced tax planning, which we'll get a CPA on here to do a lot of those videos with us. The estate planning side of things, which Don will jump on and do a lot of those with us. And then also the life insurance and kind of the risk management side of your financial plan, which is where Brian and his team will come in and help us out a lot with a lot of those videos. So we're going to have a lot of information coming out to you guys. If there's anything in specific that you guys want to learn more about, anything in specific that you have questions on, or I think the thing I get the biggest kick out of these days is hearing all these strategies that clients come to me with that they saw on TikTok or Facebook or something like that.
Yeah.
Look, be careful. There's a lot of gurus on TikTok, and they give a lot of half truths. And so I would just be careful on there. And if you have any questions about any of the strategies that they talk about, we'll be happy to cover those as well. I know I had to bring up the IUL and the taxing of the loan if you let it lapse, because that's one of the things my wife actually recently saw on TikTok was the what's it called, the infinite banking idea.
Yeah.
And the way that the infinite banking works, and that it's kind of describing an IUL or a whole life policy in the way that they work. But the video actually made reference to you borrowing from your own death benefit. You're not borrowing from your death benefit. You're borrowing from the insurance company. So there's a lot of misleading information out there. So we want to try to clear as much of that up as possible and get you guys whatever information that you're interested in hearing more about. Let's see. Do we have anything else? Doesn't look like we have any questions. So, all right. Well, then we will just wrap this up. Brian, again, thank you for coming in. I'm sure that we're going to do a handful more of these in the upcoming months. And so I appreciate you and your time and helping everybody out. I want to thank everybody for coming. For those of you that are watching the replay of this or watching this later, again, same goes for you. Feel free to give us a shout if you have any questions or anything that we can do to help you guys. All right. Other than that, you guys have a wonderful rest of your day and have a great upcoming weekend. Brian, I'm sure I will be talking to you very soon.
Sounds great. Thanks again.
Yes, sir.
Thank you. You too.